In this episode of Fireside Chat with Neo, we're going to look at whether you need emerging markets in your investment portfolio. Now, as a global investor or a non-resident Indian, you probably have a lot of options on the table in terms of where you can park your investments. You can participate in developed markets where you're already a resident, or you can also look at emerging markets like India for your asset allocation needs. So the question really arises, do you really need exposure to India if you're a non-resident Indian and you're not planning to come back anytime soon, and you may even end up retiring in the country that you're residing in today? The answer to this question, the simple one of course, is that you do need exposure to emerging markets. Now let's take a look at why that makes sense. The first reason, of course, being that developed markets have a lower rate of inflation, a more stable capital market, and return expectations are on the lower side in terms of how equities will perform. On the other hand, emerging markets have a longer runway for growth, more uncertainty, so the risk reward tends to be a little higher on the emerging market side. Moreover, with inflation at higher rates, automatically your expected returns are also at a higher rate. The second thing that we need to consider is that in today's growth context of how the global economy looks, developed markets are actually on a weaker wicket. They've had more in terms of economic stimulus that they need to unwind and normalize. They're also heading into a phase where they've come out of a high inflation cycle. There's a lot of uncertainty around employment as well as economic growth. So developed markets are actually not on the greatest wicket today. At the same time, their equity markets have rallied quite a bit. So valuations in terms of future growth prospects can actually be a little bit stretched on the developed market side. Meanwhile, if you look at emerging markets, at least the larger ones tend to have more visibility in terms of growth, as well as more stability, less policy looseness that they need to sort of rewind. And this actually creates a better context in terms of risk reward if you're looking at EM allocations. The third thing that most NRIs are worried about is, what if currency depreciates? This means that if you, let's say you were a US based investor and you put in dollars into Indian markets, then you're investing in rupees, and if the rupee depreciates against the dollar, then when you bring that money back and you repatriate it into dollars, you actually lose some money on those currency transactions. Now, currency movements are one of the most difficult things to predict, and one cannot insulate themselves fully from how these currencies behave against each other. But if we look at the current context, what we notice is that the dollar has actually strengthened quite a bit against the rupee as well as other currencies in the last couple of years. You're also heading into an interest rate cycle where things are moving from a higher level to a lower level, which could result in less demand for the dollars. As well as at the same time, you're seeing India's economic fundamentals actually strengthen, their currency reserves improve, and overall their fiscal position also consolidating in a better direction. So from a macro perspective, it doesn't look like you would really have to worry about currency depreciation the way you have in the past. But of course, these things are unpredictable, and it's worth considering what has actually changed from the past to the present. So when we put all of these things into context, we'd realize that there is a good case for non-resident investors to also participate in domestic markets. If you'd like to know more about how you can do that, get in touch with us.